Welcome to Global Trends. Please subscribe and hit the bell icon for more breaking updates. In April 2025, China made a seismic move, one that sent shockwaves through the global aviation industry. The Chinese government ordered its airlines to suspend all future deliveries of Boeing aircraft, a decision that stunned both Wall Street and the aviation world. This wasn't a minor dispute, it was a decisive break, closing the door on decades of business between Boeing and one of its largest, most lucrative customers. For years, Boeing jets had been a familiar sight in Chinese skies, symbolizing a partnership that fueled growth on both sides. The immediate trigger? A dramatic escalation in the US-China trade war, which had already been simmering for months and now boiled over into the aviation sector. The US had slapped tariffs of 145% on Chinese goods, aiming to pressure Beijing and protect American industries. China retaliated with 125% tariffs on all US imports, sending a clear signal that it would not yield to American demands. Suddenly, Boeing jets became far too expensive for Chinese airlines, forcing the government's hand and making new purchases financially unfeasible. But this wasn't just about economics. It was a strategic message to Washington. China would not back down, and it was willing to use its purchasing power as leverage. The trade relationship between the two superpowers, once a pillar of global commerce, had unraveled almost overnight, leaving investors and policymakers scrambling. Boeing, a symbol of American manufacturing and innovation, now faced a closed market with global consequences that threatened its future. The impact rippled far beyond Boeing's headquarters, affecting workers, suppliers, and entire communities that depended on the aerospace giant for their livelihoods. For years, Boeing jets in Chinese airline fleets symbolized global trade and cooperation. Now, that era had ended, leaving uncertainty in its wake. The decision set the stage for profound uncertainty in American industry, raising questions about the future of U.S. manufacturing and international partnerships. The world watched as a new chapter in U.S.-China economic rivalry began, with ripple effects felt in boardrooms and factories around the globe. The question now loomed larger than ever. What would come next for Boeing, for China, and for the future of global trade? The halt in deliveries came as Boeing was already reeling from internal crises. Safety scandals, including the 2024 door panel blowout and earlier MAX crashes, had battered its reputation and slowed production. Since 2018, Boeing had lost over $51 billion, with the Chinese market already largely closed since 2019. The new tariffs were the final blow, making Boeing jets unaffordable for Chinese airlines. State-owned carriers faced impossible choices between expansion and government directives. Beijing even considered financial aid to offset the crippling costs of leasing Boeing jets. For Boeing, the trade war turned a tough recovery into a near-impossible challenge, as it became a pawn in a high-stakes geopolitical chess match. The company's future in a key market now hung by a thread. The financial hit to Boeing was immediate. Its stock price dropped sharply, deepening a trend that had already wiped out a third of its value since 2024. Boeing only gets paid upon delivery, so a halt means billions in frozen revenue. With dozens of undelivered planes piling up, major orders from China's top airlines were suddenly in limbo, slashing projected earnings. China's market isn't just big, it's the future of aviation. Losing it hands a huge advantage to rivals like Airbus. Reallocating jets to other markets is complex and can't fully offset the loss. The pain spread through Boeing's vast supply chain, threatening thousands of jobs and businesses across the U.S. Boeing's financial health is deeply tied to the broader American manufacturing ecosystem. China's aviation market is not only the world's largest and fastest growing, but it's also a critical battleground for global aerospace giants, a market that every aircraft manufacturer dreams of conquering. Over the next 2 decades, China is projected to need more than 8,800 new planes, an astonishing figure that represents about 20% of all global demand for commercial aircraft. This surge is driven by a rapidly expanding middle class, booming domestic tourism, and a government eager to connect its vast cities. For Boeing, losing access to this enormous market is a catastrophic blow, one that simply can't be offset by sales elsewhere in the world, no matter how hard the company tries. The Boeing-China partnership once stood as a powerful symbol of US-China commercial cooperation, with joint ventures, technology sharing, and deep integration between the two economies. The halt in this relationship dismantles years of trust and collaboration, turning what was once a key customer into a source of uncertainty and risk for Boeing's future. For the U.S. economy, Boeing's sales to China have been a major engine of growth, supporting millions of American jobs across manufacturing, engineering, and supply chains. Each plane sold to China is a multi-million-dollar export, fueling local economies, strengthening the national balance of trade, and keeping thousands of small businesses afloat. Boeing's economic footprint is massive, contributing billions to the U.S. economy and supporting 1.6 million jobs, from factory workers to engineers and suppliers in every corner of the country. When that export pipeline is cut, the impact is felt far beyond Boeing's balance sheet. Entire communities and industries feel the shockwaves. The loss reverberates through small towns, local suppliers, and the broader American economy, threatening livelihoods and the stability of countless families. The stakes for U.S. industry could not be higher. What happens in China's aviation market doesn't just shape the future of flight, it shapes the future of American prosperity. With Boeing sidelined, Airbus stands to gain the most. Already dominant in China, Airbus could solidify its lead for a generation as Chinese airlines scramble to meet demand. But Airbus can't instantly fill the gap. Production is complex and backlogged, so Chinese carriers face long waits. This opens the door for China's own aerospace ambitions. China's state-owned COMAC has developed the C-919 jet to compete with Boeing and Airbus. The trade dispute could accelerate COMAC's rise, with Beijing pushing airlines to buy Chinese. Yet, the C-919 still relies heavily on Western technology, especially U.S. engines and avionics. A full ban on U.S. parts would cripple not just Boeing but China's own aviation dreams. The global supply chain is so intertwined that a clean break remains nearly impossible. Even in a trade war, interdependence shapes the future of flight. Boeing's crisis isn't just about stock prices, it's about people and communities. Nearly 150,000 Americans work for Boeing, with millions more jobs tied to its vast supplier network. When Boeing slows production, suppliers across the country feel the pain, cutting shifts, freezing hiring, or laying off workers. These are high-skilled, well-paying jobs that support families and local economies. For many, the trade war's impact is personal lost hours, lost jobs, and growing uncertainty. The ripple effect reaches kitchen tables in towns far from Wall Street or Washington. The Boeing Halt is a stark reminder global trade decisions shape everyday American lives. The future of U.S. manufacturing hangs in the balance. The Boeing Halt is a watershed moment for American industry, marking a turning point that few could have predicted just a few years ago. It's not just about one company, it's a signal that the landscape of global manufacturing is shifting beneath our feet. It exposes the risks of trade wars for companies dependent on global markets, highlighting how interconnected supply chains can unravel quickly when international tensions rise. U.S. dominance in aerospace is no longer guaranteed, competitors are rising and the world is changing. New players are investing heavily in technology and innovation, eager to claim a larger share of the skies. The crisis forces a national conversation about trade policy, jobs, and America's economic future. Lawmakers, business leaders, and workers alike are asking tough questions about how to adapt and stay competitive. Aggressive tariffs can backfire, hurting the very industries they aim to protect. The ripple effects are felt across the economy, from small suppliers to major exporters. No single market can replace China's scale. The long-term risk is China building a self-sufficient aerospace sector. If that happens, American companies could lose access to one of the world's largest and fastest-growing markets. That would be a loss not just for Boeing but for the entire U.S. tech sector. The innovation ecosystem that supports aerospace could be weakened, affecting jobs and investment far beyond aviation. The grounding of Boeing jets is a symbol of a new, more contentious era in global trade. It's a warning sign that the rules of the game are changing, and not always in America's favor. The economic ties that once bound the U.S. and China are fraying. Decades of cooperation are giving way to uncertainty, mistrust, and competition on a global scale. The decisions made now will shape the future of American industry and jobs. Every choice, by government, by business, by workers, will determine how the country adapts to this new reality. The fate of thousands of workers, and the strength of the U.S. economy, hangs in the balance. What comes next will define not just the future of Boeing, but the future of American leadership in the world.